Hello, everyone. I'm pleased to welcome you to our event today entitled Evolution of the New Normal in 2023. My name is Ben Alvarado. I'm the Executive Vice President and Director of Core Banking here at California Bank and Trust, and pleased to introduce you to our esteemed panelists. Joining us a little later in the presentation is Anthony Valeri, Investment Management Director of Wealth and Fiduciary Service for CB&T. Anthony is a chartered financial analyst who works with our clients to help them understand complex financial strategies and market dynamics. He has more than 25 years of experience in wealth management and financial services and is regularly quoted in the financial media. I also happen to know him, and he's a pretty great guy. We're lucky to have him here today. Starting us off today is our guest, Jerry Nickelsburg. Jerry's the director of the renowned UCLA Anderson Forecast. He earned his PhD in economics from the University of Minnesota, specializing in monetary economics and econometrics, and today plays a key role in the economic modeling and forecasting of the national, California, and regional economic forecasts. If you have heard Jerry in the past, then you already know you're in for a real treat. Let's get started. Jerry, I'll hand it over to you.
Thank you, Ben, and thank you for that nice introduction. Always a pleasure to be here with our friends at California Bank and Trust. I have a few slides that I'd like to share with you. They're not comprehensive because that would take up the whole time, but just to give us some foundation in what's happening in the economy here today. And so let's get started. And I want to start with GDP. We're looking at an economy where we have a great deal of uncertainty, and that uncertainty certainly has to do with what's happening with the growth of the economy represented by GDP. And when we think about recessions, and everyone is talking about recessions these days, we're comparing what might happen in the coming year to the recessions that have occurred since World War II, 11 of them. But only one has a characteristic that this possible future recession might have. And that's 1981. All of the others were characterized by overbuilding of houses, overbuilding of military equipment during wartime, overbuilding of computers and software in 2001. Today, if we do have a recession, it will be like 1981, where the Federal Reserve purposefully took the economy into a recession to squeeze out inflation. So let's look at that and look at inflation and what the Fed's track record has been. And so what you see in the graph in front of you, well, there are a lot of things that you see in the graph in front of you. The blue are the actual levels of GDP. You see this big drop there. That's the recession of 2020. And then we come back up. We come almost to that dashed black line. The dashed black line is a 2.4% growth rate, which was the 2018-2019 growth rate. And we're just about up to that trend. And then the economy this year, 2022, has kind of flattened out, not done much in the way of growth. And trend, of course, has kept going up. And then we move into the reds there. The light red is the fourth quarter of this year. We don't have data on that. So that's a forecast. And then the darker reds are a forecast which assumes that the Federal Reserve starts moderating quickly increases in interest rates, and assumes that inflation rates start coming down quickly. And we may be seeing both of those happening today. The Consumer Price Index was actually released this morning, and it showed a fairly significant drop in prices. But if the Fed continues on the path that they said they were going to follow, which is one of aggressive increases in interest rates until they see in the rearview mirror inflation rates down in the 3 to 2% range, that's going to induce a recession, and that's that green line there. But notice there's not a lot of difference between the green and the red. And as we get over to the end of 2024, we're below that black trend line, but we're getting towards it. But why is the black trend line so much above the actual and forecast GDP? One of the reasons is that we've had a structural change in the labor force. We've lost 3 to 4 million people in the labor force, mostly boomers retiring. And so if we move that black line down to represent that, you see that we went above trend. And now this year, we're going to end pretty close to trend, but then that slowing of growth in 2023, whether we get a recession or not, is going to keep us below trend, but pretty close to trend, and we'll hit it in the early part of 2024. So let's turn to inflation, which is what Fed policy is all about. And what I've done here is take the CPI, not this morning's numbers. I didn't redo this today. So this is the last one, October 2021 to October 2022. It's the year-over-year inflation rate. And the blues are the contribution of everything over to the left. It's broken down by category. And the orange is the contribution of the category that the block is associated with. So if you look over on the left-hand side, you see the second one there is alcohol. Alcohol prices, both from the grocery and liquor store, as well as in restaurants and bars, have been going up quite sharply. But alcohol is a small part of the average household's budget. So it gets a small weight in the CPI. Now, if we look over on the right-hand side, the things that are really impacting inflation are going from right to left: shelter, food, energy, and other transportation. Those are those big four. In today's CPI numbers, other transportation went negative, but it's all in food and shelter. When Chairman Powell was in front of the Congress, in front of the Senate testifying, he was asked by Senator Warren, so raising interest rates, is that going to affect the price of food? The answer was no. Will it affect the price of energy? No. He was not asked about shelter, but it doesn't affect the price of shelter either, because this is rents, not the price of homes. And in today's numbers, it really is all about shelter. It's now down to 7.1%. So what is the Fed trying to do if it doesn't affect these big three? What they're trying to do is affect interest-sensitive sectors like new home construction and durable goods orders, and maybe autos. And we see auto prices actually have been declining. And so it's a very blunt instrument that they're using. It's somewhat akin to maybe putting a finishing nail in molding, but all you have is a sledgehammer. Most of the time, or sometimes, you might get that finishing nail in, but most of the time you're going to break the molding. And we can see that in the Fed's history. The graph that you see here, the line represents Fed funds rates. So this is the interest rate that the Fed controls. And it goes up and down. The red is going up, the blue is going down. The dots that you see, the red and green dots, represent times when the Fed moderated, when they started pulling back on interest rate increases. And there are only, about 8 observations here. 2 are green. The Fed started moderating and reducing interest rates and did not induce a recession. And the other 6, the Fed did not moderate before a recession happened. And so the Fed's track record is not great. But there's good reason for that. No one knows where the red and green dots are. And that's what the Fed is struggling with. They don't know when they really need to pull back to hit a green dot. And there is a real risk that they're going to hit a red dot. And that's the reason why we have 2 scenarios. So that's the basis for what's happening in the macro economy. And let's turn to a few things in California. And there's actually some really good news here relative to the US. And I want to emphasize the word relative. The first is tech. We have headlines about tech layoffs, and this is a screenshot from CNBC. Tech layoffs, and it goes through November 2022, and you can see they're increasing. But the tagline here is ballooning tech layoffs not the canary in the coal mine. And I think the way to think about this is maybe through the illustration of what happened at Twitter. And I'm not talking about all of the turmoil between their new CEO and employees, but the layoffs. So Twitter laid off amongst their 7,000 employees, laid off or had quits of maybe about 4,000 to 5,000. But here in California, in the Bay Area, it was maybe 900 or less. That the vast majority of these layoffs were across the country and abroad, where more than 1,000 Twitter employees were laid off. So the impact of this on Silicon Valley and from Meta and others is really diffuse now, whereas in 2001, it was very much concentrated in the Bay Area in information technology. And further to that, in the week following those layoffs, 1/3 of all of the Twitter employees who were laid off were already reemployed by other tech firms. So what is going on here? I think we can understand that by looking at where the investment was. And this is 2021 and 2022 venture capital investment by geography. On the right-hand side is venture capital investment by state, 2021. You see California is all the way over on the left-hand side, just far above all others, with New York and Massachusetts following, and then Texas at 1/17 of California. That was 2021, a banner year for venture capital investment. On the left-hand side is the first half of 2022, and this is a finer geography. San Francisco Bay Area at the top, then New York metropolitan area, but then Southern California. Southern California is actually bumped up to be number 3 as a geography that is receiving venture capital investment. And if you dig a little deeper into this, what you find is this investment has gone into angel and first funding and second funding of companies. And these are the companies that are hiring. And this money, this very substantial amount of money, will carry them through 2023. Where we're seeing the layoffs are the large tech companies that grew and bought a lot of other companies or started new business lines, and they're now consolidating, getting rid of business lines that didn't work, and that's sort of a natural evolution. But the party's not over with, certainly in Silicon Valley and Southern California when it comes to tech. Indeed, firms throughout the world are trying to find labor-saving technology, and that plays directly to California's tech sectors. Okay, so let's move to housing and housing construction, because that's an interest-sensitive sector. And the graph that you see here is building permit growth. So these are permits for new single and multifamily housing by state for the first 9 months of 2022. That's the blue. And that's the difference between that and 1 year previous. And the red is July to September, the last 3 months of that 9 months that we have data on. And you notice if you look over on the right, you've got Utah, Tennessee, Colorado. The reds are very negative, but the blues are also negative. In fact, for most states here, and this is obviously not all 52 states, but for most states, the reds are negative the last 3 months. And for many of them, all 9 months were negative. But if you look on the left-hand side, there are 2 states that remain positive. And the first one is California. California has, on a 9-month basis, the largest percentage increase in building permit growth, and today remains on a track to increase the amount of housing built, not decrease it. Part of the reason is that laws that have been passed by the California state legislature over the past couple of years have brought to the market new products like ADUs and duplexes that weren't there before. So even if interest rates are higher, there's still a lot of low-hanging fruit, and builders are expanding their construction. and just a digression, we can talk about this a little bit later. There's also spillover here for non-residential construction, because with growth in tech and with growth in other sectors in California and new building, there's going to be a need for new non-residential. So construction should maybe not be strong, but is definitely not going to be as weak as in the rest of the U.S. And that leads me to one other point that I want to make, sort of as a foundational point, and that is we have now an increase in defense budgets. They went up last year. They're up again by $80 billion this year. And that disproportionately comes to California in the form of defense durable goods. And so we have this picture here on the left-hand side of the B-21 bomber that was just unveiled last week. That is going to be manufactured in Palmdale, California. It's an $80 billion minimum manufacturing program that is on the way. And on the right-hand side is a shot. I saw this, but I unfortunately didn't get my camera out in time. So it's someone else's picture, but it is the Falcon 9 from SpaceX being launched out of Vandenberg. And so space, commercial space, as well as defense, are going to be big drivers of the California economy in the coming years, and mean that California, unlike the last 4 recessions, will, if we do go into a recession, have a very moderate recession, if one at all. And in the slow growth that I showed you in the beginning, California will be growing faster than the US. So in both scenarios, we have some good news, or relatively good news, for California. I just want to show you some numbers here to wrap up this beginning discussion. This is employment growth. R means recession. No R, obviously, no recession. And so we have 2023 is the middle number, and the difference in employment growth is about 0.6%. So in the recession scenario for 2023, California employment is still growing, and then 2024 growing, and that growth is limited by labor force growth. And then, so just to summarize, defense, tech, government, which we didn't discuss, but also construction, they all slow less than the US, if at all, in both scenarios. And so the outlook for California going forward is actually not bad at all. And let me just stop there and turn it back to Ben. Thank you.
Well, thank you, Jerry. As always, you've given us a lot to think about. Now we're going to hand it over to Anthony Valeri, who will discuss the current market outlook, and then we'll open it up for questions. Anthony?
All right. Thank you, Ben. Thank you, Jerry. Let me bring up my presentation here. Hopefully everybody can see that. I wanted to touch on some of the highlights for our view on the markets, both for stock and bond markets as we look to 2023. It's been a difficult year. The recession risks that Jerry referred to are very real. We think there's a significant chance of a recession, and it's not just the Fed, but that recession risk that is weighed on the equity market, and the Fed certainly pushing interest rates higher, which has hurt bond investors. So what happens after a weak year? And certainly 2022 will go down as one of the weakest years, likely for diversified investors for sure, one of the 3 worst. Here we are with data through the end of November. You can see where 2022 ranks pretty high up there, going back to data all the way through from the end of World War II. And you can see that full year performance, this is down 16% through the end of November. At its peak, the S&P was down 25%. When you look at other prior episodes, there's typically a bounce back in the subsequent year because markets are forward-looking. On average, the equity market bottoms 4 months before the end of a recession, so we don't encourage timing the market. You can see that in only 2 cases were returns negative, 2001 and 1973. There are some corollaries to the current environment. One, we do have higher valuations, and we still have a sticky inflation problem, even if it is decelerating. But more importantly, on the far right, the next year maximum decline. And that still suggests that as you're approaching a recession and there's still a lot of uncertainty with regards to the Fed, and the Fed also allowing their bond portfolio to run off, that the prospects of continued volatility are high. So we continue to invest and manage for that ongoing volatility. You can see on an average basis, the next year is up 14.9%, which is above the historical average. The average decline is 14.3%, not too far off of the average decline, but still suggests that volatility is going to be an issue for investors as we head into the subsequent year. So we remain a little cautious. And one of the reasons we are is that earnings estimates may be too high in the equity market. And earnings are the lifeblood of stocks investments. And since the beginning of October in particular, estimates for both 2022 and 2023 have come down quite a bit. These are total earnings on the S&P 500 index. Growth rate for 2022 now expected to be about 4%. With no growth in the fourth quarter. We won't get fourth quarter data till the middle to end of January. And then the expectations for 2023 call for about a 7% growth rate. Now, that might still be too high, and I think would definitely be too high if we have a recession. So this, to me, is a risk point for equity investors, even with the decline in the equity market. So it's something to be aware of. Quite possible corporations remain more resilient, and we do think there are pockets of the market that will be more resilient, but this remains a negative overhang for equity investors. Knowing exactly what that growth rate would be and that it remains positive is a potential challenge and therefore likely to keep the markets volatile. We do think it gets better for diversified investors. I'll get to that later. The importance of the earnings trajectory is that it is the key driver, and I can't find a better chart than this one to show you on that. This is the S&P 500 going all the way back to 1960. That's the black line. And the gold line is earnings. The annualized rate of growth for the S&P going back to 1960 is 7.25. Earnings growth has averaged 7.1. If you were to go back and look at GDP growth over this period, it's been 3%. So it's earnings, not the economy, that ultimately drive the equity market. So the reason to focus on those earnings. The other challenge is, aside from the earnings growth rates, the markets bounced back in October and November. That's certainly welcome, as investors were overly pessimistic, but the valuation now, as measured by the PE ratio, is above the period average, the last 15-year average, and just above 18. Now, this isn't an excessive valuation by any stretch, and I think it's important to acknowledge how valuations have come down since the end of 2021. The market is certainly cheaper, but not outrightly cheap going forward. So that also raises some concerns that investors will continue to debate what is the right valuation for equities given recession risks and uncertainty over earnings. So again, I'm going to repeat it. Our theme is for continued volatility. We do expect a modestly positive mid-single-digit return for equities as we look into next year. Ultimately, the second half, we should see some of those risks receding and better for equity investors. One point of the market that I think is really worth stressing is what's working in this environment. And under the surface, there's really been a dichotomy within the equity market. And I'm speaking specifically to growth versus value. Now, growth, you're talking about more expensively valued technology companies. This part of the equity market has really underperformed here in 2022. The NASDAQ index still down about 27% for the year versus the S&P down about 13, including dividends. Whereas value, those dividend payers, more consumer staples, utilities, some of these other areas that are more conservative and again pay dividends, have outperformed. And this is the 5-year trailing return differential between growth and value. A rising line means that growth is outperforming value and vice versa. You can see the sudden shift in abrupt shift from late 2021 into 2022. And that tells you that value has come storming back and in vogue with investors. Now, it's been a sharp run, but still that outperformance for growth is still about 40% on a 5-year trailing basis. So there's still room here for this sector, the value stocks and what we focus on, dividend payers in our investment portfolios, to continue to do well within the market. With the Fed raising rates and interest rates high, that there are those companies that pay dividends have been rewarded relative to the non-dividend payers. So we do have a bias towards value. We think that continues into the new year. I think it's also worth noting that since the beginning of October, interest rates have come down. The US dollar is also weakened. Those are two factors that typically would have helped the growth sector, and we're just not seeing it. It's a little concerning, and therefore we continue, although we're diversified, have an emphasis on this value sector. So something to keep in mind on portfolios and something we're going to implement in our portfolios going forward. So important to know what's working. This could still be a very long trend in the equity market. I mentioned the bounce back in October and November. Here's another way to look at it. This is a one-year chart of the S&P 500 index. Some folks have asked me, is this the all clear? And not necessarily. We've seen rallies like this before. We call these a bear market rally. Do need to see improvement on the fundamental side, more of a slowdown in inflation like we saw today with the CPI, and signals from the Fed that they may be nearing the end of their rate hike campaign. And we'll get more info on that tomorrow from the Federal Reserve. But you can see there have already been, including this one, 3 significant rallies this year, one totaling almost 11% back in March, 17% over the summer, and the current rally up about 13% and change. So not necessarily out of the wood. This kind of behavior is normal, and I think representative of some of the chop that we expect going forward. Another point we're using in our portfolios is active management. There's been a lot of attention towards passive management using ETFs to get broad market access. We do use those in our portfolios. They are very effective tools. But when the Fed is raising rates, removing its support from the market, there's something to be said for active management. There's more opportunity, and you're seeing that this year. In this chart here, you see the blue bars with the S&P 500 performance. This was through the end of September, and the red dots represent the percentage of large cap managers outperforming the benchmark. And at 56%, that is the highest since 2007, and really the first notable improvement in what's been a 12-year span of passive outperforming active. So an environment that we think is going to be volatile and likely stay volatile. We have an emphasis on active management, especially with the Fed removing its support from financial markets. It's worked this year. We think it's something that continues to work going forward. So a modest shift within our equity construction within our portfolios. And as we look at the bond market, I thought it helpful ahead of the Fed meeting to look at what's priced in terms of Fed interest rate action. And you can see the futures market is showing that they think the Fed's going to raise rates to roughly 4.9%. That's another 50 basis points on top of the 50 expected at tomorrow's December meeting. So that would take it to about 4.9. That's roughly, I think, a fair estimate if the Fed does update their forecast to 5%. The other part that's worth noting, well, 2 things. One, there's a lot of rate hikes priced in. 2, the other part is the deceleration you see on the right-hand side of this chart, which shows that the market's pricing in a steady stream of rate cuts starting in late 2023. And that might be a little too early if the Fed does decide to keep rates elevated for some time. These expectations for rate cuts in the latter half of 2023 and into 2024 has led to a very strong rally in the bond market, with the 10-year Treasury coming down from 4.25% to 3.5%. If this reverses, we might see some upward pressure in interest rates, but we do think we're very close to the peak in the 10-year Treasury yield if we haven't seen it already. But we do think there's some upward pressure coming as markets adjust to what we think will be a Fed that stays on hold for longer. As it is right now, futures showing about 100 basis points worth of rate cuts from June 2023 all the way to June 2024. Bond market valuations have gotten better. This is the yield on the 10-year Treasury inflation protected security. We call it a real yield. This is the yield on the security. The rest of the compensation comes from CPI growth. The higher the real yield, the better value in high quality bonds, and vice versa. On the right side, you can see the increase in the real yield, and that indicates better value, but the real yield is still back to a point it was at 2010. So certainly attractive relative to the past 10 years, but if you go back before then, it was routinely at right around 2%. So it's hard to call bonds cheap either, and that's why we think that there'll be still some volatility in fixed income markets. going forward, and why, if the Fed ultimately keeps rates higher, that you might see some additional pressure on the 10-year to bring it back up to 4% or 4.25%. However, all of that aside, I think it's really important to note the improvement in bond market return dynamics going forward. This is the worst year on record if you are a high quality bond investor. And one way to look at it is to look at the 10-year Treasury yield shifted forward 10 years, and you can see it's a pretty good proxy for high quality bond returns. The gold line represents the 10-year annualized return of the Bloomberg Aggregate Bond Index. That's an average number. Some years are better, some are weaker, but it tracks that yield very closely. And the increase in the 10-year Treasury yield says that bond returns should go from near zero to up about 4% annualized. That's a big improvement from the current environment. I can't stress that enough. We think diversification, which has failed investors this year with the 60-40 portfolio, as we call it, having one of its worst years on record, we think that improves next year. Bonds are back from a diversification standpoint, and those yields will buffer portfolios better going forward. 10 years more than doubled this year. Short-term rates have more than tripled. That extra interest income will make a difference. In terms of other sectors of the bond market, the high yield bond market, the average yield advantage is still relatively modest, right around 5%. That's roughly in line with the historical average. It is not bracing for an increase in defaults or a recession. We think this is slightly overvalued here. So our focus within the bond market is high quality bonds. Take advantage of those yields, and in the event of a recession, you could get some modest price appreciation of those bonds, just not being compensated as well in the high yield bond market. In fact, slightly better value in emerging market debt in our view. So we're focused on high quality bonds and slowly removing some of that defensive interest rate posture to take advantage of higher yields. So I will step aside. Thank you for the views. Ben, I'll turn it back over to you.
Fantastic. Thank you, Anthony. Great update. We've now gotten expert perspectives of the trends in both the economy and the market. We've been getting questions from our listeners, so let's take some time now to address those. Just as a reminder, if you'd like to submit a question, please use the Q&A function or feel free to post your question in the chat, and we will get to as many of those as possible. I'm going to go ahead and read some of the questions that have just come in. So Jerry, Anthony, feel free to jump in and respond, but let's start with commercial real estate in California. What does the future look like in regards to commercial real estate in California? And are there any new developments? If so, what are you seeing?
Okay, so I'll jump in on this. What does the future look like? Well, of course, it depends on what kind of commercial real estate. Over the past 10 years, even more, industrial space has been a very hot market. And that's been principally warehouses. It remains a very hot market. And that's because warehouses are fully leased. You have vacancy rates that are down in Southern California, down in the 2 to 3% range. In Northern California, they may get up to 4%. That means that you can build a new industrial space and you can make those business plans hunt. And so we are expecting continued building of warehouses, but also the reshoring of manufacturing, particularly manufacturing that requires high-skilled labor, is going to come, at least some of it's going to come to California. So we're seeing new factories being built in places that you wouldn't expect, in Orange County, for example, where you have a very high-skilled labor force that can manufacture sophisticated goods. So industrial space looks good. The surprise is retail. So not much has been built in retail, and a lot has been taken out of retail over the last 5 years. Now with the expansion of housing in California and the return now post-COVID, or at least pretend post-COVID, to in-store shopping, there's not enough retail. And so we're seeing some move to build new retail, certainly with the new housing developments. You need it there, but also in other parts of California. And the exceptions to that are San Francisco and Los Angeles, where retail depended very heavily on on tourists, particularly tourists from Asia, and we haven't seen them come back. And so retail looks like it's turning around. Industrial looks good. Office is on the sidelines. So we see a lot of growth in office using employment, what we at least used to call office using employment. But office developers are looking at when is return to the office going to be predominant, and what does that look like? And owners of other than Class A space are looking at maybe taking capital losses or converting buildings to housing or mixed use. So we're seeing a lot of sort of churn in that market, but not a lot of development because there's still a great deal of uncertainty there.
Question just came in the chat. Anthony, this seems kind of perfect for you. I have spare cash. Where should I invest it?
Yeah, it's we get that one a lot, and despite the challenging outlook, we're recommending all clients take a dollar cost average approach. In other words, sequentially put in your investment over a, call it a 3, 4, 5 month time frame to take advantage of lower, average out your price, take advantage of those dips. Just a reiteration, it's impossible to time the market. So to try and wait, you have to expect that when the market's going, both stock and bond markets going lower, and you're going to get in at a better price in the future. Just impossible to do that. I've never seen anyone do it successfully, and that includes some of the the best pros out there. Some other examples on that front. In June, middle of June, things looked really dire in terms of inflation. We saw some indiscriminate selling, and lo and behold, there's a 17 or 18% rally in the equity market. Same in late September, early October, things were looking negative, and we had a bounce. And I'd add in early October, especially for Europe, concerns over an energy crisis in Europe for the coming winter, really driving some underperformance of international securities. And all it took was China saying they might ease back on their zero COVID. The dollar weakened slightly, which really kicked it off. And then you had a very strong run for international equities. No one saw that coming. And now international is actually outperforming on a year-to-date basis versus the S&P 500. So, you can never time those things. That's why we very much remain in the camp of staying diversified. Make sure when you do invest, you have a 3 to 5 year horizon and write out those ups and downs. But for the near term, yeah, dollar cost average in, and don't get too cute with trying to time the market.
So Anthony, you pointed out that that the dollar's weakening, that interest rates are coming down. We're seeing a lot of things happening in the markets, and I talked a bit about inflation data, et cetera. And when we look at, for example, the pattern of the yield curve, what we find is that pattern doesn't look like any of the historical patterns, and that's, I think, because of two things. One is we're coming out of a pandemic-induced recession, and we've got an activist Federal Reserve in ways that we haven't seen in 40 years. So would you say, you said it's hard to time the market. Is it even more difficult today because the data is so mixed? It
is really mixed. You can make a strong case that labor and business investment are really running contrary to a recession scenario. We still have a tight labor market. With regards to the yield curve, yes, it's been a great signal historically. It's harder now given the mixed signals you're seeing from the economy. And more so with regards to the yield curve, it's a little inside baseball, but what we call the term premium, what you typically see on a longer term treasury yield versus short term, has come down over the years. And that's partly due to the Fed buying bonds and, like you said, having a big inventory of bonds. But it also reflects an aging population, move more to fixed income securities. And therefore, there is a question to be had, is if the yield curve is as effective an indicator as it has been in the past. I don't think it's a given by any stretch. Something certainly we take seriously given its track record. But to your point, Jerry, that's something we downplay a little bit in the current environment.
Yeah, I think we feel the same way, that we're dealing with a lot more uncertainty in the economy than we have, certainly in the last 6 decades.
Thank you. Let's, Jerry, you mentioned California housing initially. Let's go over to California housing. We got a few questions. I'll start with the first one. Prices seem to be dropping right now. How long will this last?
So, that's a great question. And it does have to do with what's happening with Federal Reserve policy. However, 30-year fixed mortgage rates, for example, they went up to 7.5%. And now they're down in the mid sixes. So it looks like Fed policy's been already been incorporated into the interest rates that mortgage lenders are demanding. But when those interest rates went up, and they went up very fast, historically fast, buyers said, I know prices are coming down. With higher interest rates, these houses are less affordable. Let's hold back. And so we've seen a drop in demand that's comparable to the kinds of drops in demand we see in recessions. But these are really just buyers holding back to see where a price is going to go. And sellers saying, I need to sell my house. I know I have to lower the price, but I don't want to lower it too much. And so there's a bit of price discovery going on. And if those mortgage rates stay about where they are or ease off a little bit, then you should see some flattening out of the price increases. In fact, in median prices, we've already seen it starting to flatten out. And so into next year, once we resolve this issue of recession or no recession, and folks see that California is going to have a better time than the rest of the U.S., then I think you see a more normal market happening.
Well, then that starts to answer the next question, but looks like people want you to get the crystal ball out. And the question is, that being said, when's a good time to buy a house?
Okay, so I have a crystal ball, or at least a picture of one with a crack in it and a Band-Aid across it. And I think that sort of answers the question. Yeah. But let me give I get this question all the time. And the answer is, it depends on what you're buying the house for. If you're buying it as an investment, then you really have to look at the long-term appreciation, where the price is, and this is very localized, right? Because the markets are very localized. If you're buying the house to live in, and it's a nice house and you want to live there, well, you're going to be getting housing services all along. And so then that the asset market equation is, which I think is the nature of the question, not as important, right? Because the value you get from living in the place that you want to live can be enormous. And so let me just quickly finish the answer with, my daughter asked me this question. And my answer was, do you like the house? Do you want to live there? She said, yes. I said, buy it. That was the fall of 2019. And she had a really nice place to weather the lockdown. So it really matters why you're buying the house.
Understood. And if you could find one, which leads to the next question is, why is there a housing shortage when it looks like people are leaving California?
Oh, the question of leaving California. Well, first of all, on a percentage basis, not many people are leaving California. But who is leaving California? It tends to be lower income Californians who are finding it increasingly difficult to rent. And so for the kind of lifestyle that they want, for the kinds of jobs and income that they can command, there are many other places that just seem better to them and probably are better. They have a better lifestyle. People moving into California are highly skilled software engineers, aerospace engineers, et cetera, command a high salary, tend to have smaller household size, and they're demanding the housing. So this is keeping home prices up. As well, what we're finding is boomers are holding on to their homes longer. We think about, well, all the boomers are retiring and going to retirement communities in Arizona or Florida, but that really isn't happening. People want to stay closer to where their kids are, and and typically retirees don't move very far.
Great observation. Thank you, Jerry. We'll switch gears a little bit. We got some more questions coming in the chat. There's been some big news around crypto these past couple of weeks in some very recent stories. But what is your long-term outlook for cryptocurrencies?
Do you want to take that?
Sure. I'll start with my view. I think crypto is in a deleveraging moment, not too far unlike 2008. I think there were some speculative excesses there. There have been a number of high-profile failures, not just FTX, but hedge funds, other firms that have simply gone out of business. And I think the industry is trying to figure out its way forward, and that might take some time. It might take a few years. However, I do think crypto in some shape or form is likely to stick around. What that looks like, I don't know at this stage. I do think the market is not distinguishing between blockchain technology and pure crypto at this point. Does blockchain have an application in the commercial world? Probably. Will it work? Will it be desired? I think so, but we don't. There's some really good applications there in terms of smart contracts that could have a value for the blockchain technology. But for now, the market is not distinguishing between the two. And from an investment standpoint, that's not something that we are including in client portfolios. Still view it as highly speculative at this stage and not including. Jerry, curious your thoughts on the topic.
Yeah, so I agree with you. I think that the way to think about the crypto industry is to liken it to social media. And crypto is about where MySpace was, which means they're, and with MySpace, the issue was, well, so what is this good for? How do I understand it? And then you get another wave of innovation, which gets you part of the way there. And that's where we're at now with Facebook and Twitter and Snap and the like. But as we're witnessing there, it's going to go through another iteration, to find the value proposition that people understand and that really make the industry. I agree, it's not going away, but what it's morphing into, I think, is still very much unknown.
Speaking of Facebook, what's your opinion on FANG and other major tech stock volatility in the short term?
That's one reason why we've favored value. Those big tech companies really have underperformed this year, a lot of it due to rising interest rates. They are also a big part of some of the this is one reason we like active versus passive. At the start of last year, the big five FANG stocks were about 25% of the S&P 500. That's the largest concentration in the top five since the early 80s. So you think you're not making a bet with passive, but you are. It's an active decision to go into passive. And I think that concentration is down now due to the underperformance of the big tech companies. But it's down to about 20, but that's still elevated. So we'd rather be diversified. We'd rather have active management to move around that. I don't see anything from the big tech companies, at least not yet, to show that they're ready to take leadership in the market. And it's been a long run for tech, so it could very well be a paradigm shift to other sectors of the market. Still have it in your portfolio, just not as much.
Yeah, I think one thing to look at in terms of tech is what is the product? Because now tech has moved across all sectors. It's in manufacturing, it's in retail, it's coming into restaurants. It's certainly in aerospace, in the medical field, and so there, is what is the value proposition of the company? Because it's no longer just the information tech, that we saw in 2001 or leading up to 2001.
Jerry, there's a clarifying question that came up for you. You mentioned highly skilled labor force. And we have a listener who's just looking to if you could define that. Would this include things like welding?
Yes, absolutely. And, what we are seeing, well, let me make two comments on it. So the answer is yes, there are a lot of skilled jobs that are not the person who's building rockets for SpaceX. But they take different skills than they did in the past because, for example, in welding, we're using oftentimes robots. And so it's understanding the welding, but also understanding how to use that augmented reality, that robot. And so that requires more skills. Doesn't require a Bachelor of Science degree. It does require technical training. And then kind of the second part of that is in the kind of construction that we're starting to see be a big part of the construction growth in California is in infrastructure and in some of this advanced commercial real estate. And that requires a whole set of skills. Those jobs pay well, but it's not a matter of carrying bricks up the ramp to build a one-story brick schoolhouse. So that industry is changing as well. But I meant both of those. So these are highly skilled jobs that command high incomes.
Thank you. It's great clarification. We have a question here on energy. I get a lot of emails about energy drilling funds. Please advise about oil and gas investments. Any thoughts there?
I'll take a stab at that. We don't have an outright position in energy. We are overweight the sector, and I don't have a specific view on whether it's the refiners or exploration. We'll say that energy's had a great run, and that those companies in the energy sector have learned discipline from 2015 and 16. They can remain highly profitable for the foreseeable future. And it's a small part of the market. Energy was one of the bigger sectors within the S&P 500. It's now actually up to almost 5%, which is shocking. If as low as 3%. Like I said, we have a slight overweight in our portfolios, likely to keep it that way. That sector is likely to remain profitable and resilient. Lots of talk about green energy, but you just can't get there from here. You're still going to be heavily reliant on fossil fuels for some time. So that's and I think the easiest way to play that is simply with the energy ETF spider. I wouldn't try to get too cute on really getting slicing and dicing that sector up too small.
Let's see, we've got another question here. Many people work from home now. Jerry, you touched on this a bit already, but maybe we go a little deeper because specifically they're talking about real estate investment trusts. So what's this doing to office space? What's the outlook on REITs?
What we're seeing in the move to work from home is a move to coming back to the office. That may mean 3 days a week, but it does mean coming back to the office. So why do we see that continuing? And the answer is that you get creativity when people are together. You're able to inculcate your team with the company's culture. You can mentor younger employees. All of those are productivity increasing activities. And firms are realizing that the longer they have their employees out of work and working on a platform like this, which has many uses, working exclusively on a platform like this, the lower productivity is happening in their companies. So they're moving workers back to the office. But one thing that you don't need that was characteristic of the previous office are all of these private offices where you can have quiet time to get your work done. You can do that at home. So you need more collaborative space, fewer private offices, maybe a smaller footprint. When you have the smaller footprint, that means that owners of office buildings have spare office space to lease out, which they will do. And so you'll see a lower cost per square foot. That'll bring in new young firms. And so that's the kind of equilibration that we're seeing. How long that plays out depends a lot on what happens in 2023 in the economy. But what about those remote workers? There is evidence now that the remote workers will be the first ones fired. Why is that? It's much easier in a downturn or when a company is experiencing slow growth to get rid of somebody that you only see in a Hollywood Squares box than someone that you see every day. It's much easier to not give them a pay raise or a promotion. You don't see them that often. So expect the ambitious worker to be back in the office. And so there's only kind of really a niche for people who are willing to do the remote work. And then finally, firms have realized that that if some of their, say a San Francisco firm, if some of their employees want to be fully remote, they don't have to pay them as much because they don't have to live in San Francisco. So, moving out to Grand Junction, Colorado might be really nice, but you're going to earn a Grand Junction salary. And that might be significantly below a San Francisco salary. So you add all of those up and it says that, yes, we're in a kind of wait and see how it plays out over time because, time matters. But the office is definitely not dead. And demand will, not this year, but within the next 5 years, certainly exceed supply and generate more office building.
Thank you. Well, we are approaching the top of the hour. And so on behalf of California Bank and Trust, I'd like to thank you all for joining us. And thank you to Anthony Valeri and our special guest, Jerry Nickelsburg. You can find a recording of this webinar on calbanktrust.com by the end of this week. With that, I'd like to wish everybody happy holidays. This concludes our presentation today. Thank you.
Thank you.
Thank you.